Good morning. It is a great pleasure to welcome you all to the Universidad del Pacífico this morning. We thank you for joining us in this ceremony in which our university will confer the degree of honorary professor on Dr. Nouriel Roubini for his outstanding academic achievements and his contribution to macroeconomic analysis and international finance. To begin with today's program, I would like to invite Professor Diego Winkelried, the chair of the Academic Department of Finance of our university, who's going to present us with Dr. Roubini's professional profile and his achievements. Professor Winkelried, please.
Ladies and gentlemen, we are gathered here this morning to celebrate the work and outstanding contributions to economics, especially in the fields of international macroeconomics and finance, of Dr. Nouriel Roubini, who is receiving the degree of honorary professor in economics from this university. Dr. Roubini is professor in economics at the Stern School of Business, New York University, and is the chairman of his own consultancy firm, Roubini Global Economics. He has served as the senior economist for international affairs on the White House Council of Economic Advisors, as the senior advisor to the Undersecretary for International Affairs at the U.S. Treasury Department, and as a consultant to the International Monetary Fund, the World Bank, the Bank of Israel, and several other prominent public and private institutions. His opinions and insights on the global economy are widely covered by the specialized media, such as the Financial Times, and he has been listed 5 times by the prestigious Foreign Policy magazine as one of the top 100 global thinkers. Dr. Roubini is, of course, famously known for his consensus-challenging views and predictions about the U.S. housing market crash that led to the global financial crisis and the Great Recession. The son of Iranian parents, born in Turkey, raised in Israel and in Italy, and educated in the United States, Dr. Roubini embodies the globalized world in which we live these days, an interconnected world that he admittedly understands in all of its complexity and is able to foresee with unusual accuracy. His fortune-telling powers, however, stem from his ability to identify relevant patterns and interactions that eventually determine the dynamics of interdependent financial markets. This ability was developed over decades, not only through the careful study of the causes and aftermaths of the Mexican, Asian, Russian, and Argentine crises, but also through highly influential academic work on a variety of topics such as monetary and fiscal policy coordination, the interaction between political and business cycles, the identification of liquidity shocks in open economies, the causes and effects of exchange rate volatility and capital mobility, the role of macro imbalances in the management of debt crisis, among many others. His lecture this morning, Key Economic Challenges of Our Times, builds on many of these fascinating matters. Dr. Roubini, I hope you are enjoying your visit to Peru as much as we are enjoying having you here with us. It is truly an honor to welcome you, the academic, the intellectual, the policy advisor, and as you put it yourself, the rock star among geeks and nerds, as part of the Universidad del Pacífico family. Thank you.
I would now like to invite Dr. Roubini and Cynthia Sanborn, our Vice President for Research, to the podium. Please, Dr. Roubini. Please. While Dr. Sanborn bestows the Medal of Honorary Professor on Dr. Roubini, I will read the text of the original diploma, which is in Spanish. El Consejo Universitario de la Universidad del Pacífico considerando que el señor Dr. Nouriel Roubini, en reconocimiento a su trayectoria académica y su aporte al análisis de la macroeconomía y finanzas internacionales, se ha hecho acreedor del aprecio institucional de conformidad con las disposiciones legales y reglamentarias vigentes, acuerda otorgar a su favor el nombramiento de profesor honorario como distinción especial, por lo cual le extiende el presente diploma para que se le tenga y reconozca como tal. Felicitaciones, doctor Roubini.
Good morning, everyone, ladies and gentlemen, distinguished guests, academics, policy authorities. It's really a great pleasure and honor being here this morning. I just arrived from New York overnight. I've been to this part of the world many times, and I visited already Peru several times. It's a great country, great people, industrious and growing, and with very solid policymakers. So it's always a pleasure and honor being here at any time, and it's a special honor this time around to be honored with this distinguished honorary degree. So it's really great being back here in this wonderful city and country. Maybe I'll spend the morning giving you a bit of an overview of the way I see the global economy in general, and maybe speak specifically about emerging market as well. Often people ask me what's the state of the global economy, whether it's good or bad. And I'm often reminded of that story of John Major was the prime minister in UK and used to go towards the end of the Soviet Union to Moscow, and he met Gorbachev, who at that time was the Secretary General of the party. And he says, Sir, Secretary General, can you tell me in brief what's the state of the Soviet economy? And Gorbachev looks at him dourly and he says, good. Major is a little bit perplexed, and he says, Secretary General, can you maybe elaborate in a couple of words? And Gorbachev looks at him dourly and says, not good. So if I had to say in one word the state of the global economy, good, in a couple of words, not good. And the point is that while there are many positive things happening in the global economy, there are positive trends, including in emerging markets, there are, of course, a bunch of things that are downside risk, and we have to think about both what can go right and what can go wrong in the global economy, both in terms of the long term and then of a more cyclical kind of consideration and factors. Let me start with some of the positives, and some of the positives are medium long term as opposed to being just short term. I think that the positive trends are the following one. Where the global financial crisis and this great recession could have turned out into another great depression, and thanks to the policy responses of different countries, we stopped that great recession, and we had since 2010 a global economic recovery. It has been lukewarm, has not been very strong, but both advanced economies and emerging markets are growing, and at the same time, financial markets that had collapsed, US and global equity fell 2/3 between 2007 or 2009. Since then, they've recovered 150 to 200%, depending on the country. So we have positive economic growth, and that's positive. Secondly, if you're looking at the balance sheets and the P&Ls of corporations, both in advanced economies and also in emerging markets, with few exceptions, they're strong, they're profitable, they have sound balance sheets, and they have the ability to spend more on hiring, on capital spending, if they're more optimistic about the future. So a good part of the private sector has now cleaned up its own balance sheets. And as we know, the source of economic growth is the private sector. A third kind of trend that is important is that there is the rise of emerging markets. Today, emerging markets are growing much faster than advanced economies. Advanced economies maybe have a potential growth of 1-2%, depending on the country, while the typical emerging market has an average growth potential of maybe 5%. Some of them closer to 4, some of them more than 4, but the average is still 5. and therefore a greater share of global GDP and global growth is accounted by emerging markets. Of course, this emerging market had a bumpy few years between 2013 and 16, but now there has been a pickup of growth also in these emerging markets. And they'll be therefore major sources and new engines of global growth, and not just advanced economies, but also emerging markets. The fourth positive is there is all these new technologies of the future that can potentially increase productivity and growth around the world. There is new information technologies like robotic automation, cloud computing, Internet of Things. There is biotechnologies, there is new energy technologies, new financial technologies, new manufacturing technologies. So we have not yet seen the impact of them on productivity growth. Maybe there is a delay between when this innovation occurs and when productivity growth is going to increase, but one can be technologically optimistic rather than pessimistic about the world economy. If you speak to the big titans of business in Silicon Valley, they're giddy with how much this technological innovation are going to change the way we live, we work, for the better over the medium long term. There are also positive demographic trends, both in advanced economies and emerging markets. People are living longer, they're living healthier, and that's a positive in terms of economic welfare. We also start to care more about the quality and not just the quantity of growth. Sustainable growth is important, making sure that we take care of the environment. The Paris Agreement, of course, the US now is on a different track. And longer term, we have to think about the fact that today there are no major wars, major plagues, major famines, like the ones that were leading to a lot of economic and human suffering for a long period of time. And finally, there are some institutions of global governance, whether it's the UN, the WTO, the IMF, the World Bank, the G20, and others, that provide some degree of global public goods. These are kind of long-term trends that are on the positive side. What are the things that you have to worry about, of course, about the global economy? We still have low potential growth, both in advanced economies now in many emerging markets. The IMF calls it the new normal. Larry Summers talks about the great stagnation. Some people call it the great deleveraging. I call it the great new abnormal rather than normal. And understanding the sources of this low potential growth, it's important. In part, is lack of structural reform to increase potential growth. A second problem, we still live in a world in which, because of the global financial crisis, there is too much debt, private and public, both in advanced economies and emerging markets, in the public sector and the private sector. And as we know, asset bubbles, credit bubbles that eventually go bust, excessive leverage can lead eventually to financial crisis, and that's something we have to worry about. Third issue we have to address is that demographic may be positive, we live longer and healthier, but the question is in advanced economies whether we can afford living longer, given unfunded social security and healthcare system. And in emerging markets, if you have lots of young people, but you don't give them education, skills, human capital, like we saw in the Arab Spring, young, angry men and women can lead then to revolts and revolution. So it's important to provide them with the skills to be able to survive and thrive in this global economy. We've seen also throughout the world a rise within countries in income and wealth inequality. In part might be driven in advanced economies by trade, migration, globalization, by technological innovation, these capital-intensive, skill bias, and labor saving, winner-take-all effects, and so on. And the combination of that rise in inequality and the fact that while trade and globalization overall is good for the global economy for most countries, but even basic trade theory suggests that trade, migration, globalization leads to winners and losers. In advanced economies, low-skill, low-value-added, blue-collar workers, and because technology, even some white-collar workers, are struggling because of trade and globalization, and now they're getting politically organized. And the manifestation of that backlash against globalization is now there's a populist backlash against globalization. The election of Trump in the United States, the vote for Brexit in the United Kingdom, the fact that there are extremist populist parties of the right and the left in many parts of Europe is a signal of this backlash. And now we see strongman authoritarian populists also being in power in some of the emerging markets. You have Putin in Russia, Erdogan in Turkey, Orban in Hungary, Kaczynski in Poland, Duterte in the Philippines. Of course, in this part of the world, you have the economic and social disaster in Venezuela. That is something you have to worry about. And the good news, however, I would say about Latin America is that since Latin America for many decades had populist governments, and usually economic populism eventually ends up in economic disaster, I think that this part of the world learned the lessons that populism doesn't work. And the positive is that whether there are countries in which there is a center-right as opposed to center-left government, all these governments are committed to economic reform and, of course, to inclusive growth. But they've learned that economic extremism on one side or another eventually leads to inflation, hyperinflation, debt crisis, currency crisis, and so on. So whether the trend is in Peru or Brazil or in Argentina or in many other parts of Latin America, with very few exceptions, Venezuela being another one, I think decades of swings of ups and downs, going from populism to extremism of one sort or another, authoritarian regimes, back to populism, a lesson that actually economic and policy and political moderation is the way to go, and therefore I think quite constructive about this social and political stability being an important source of stability for Latin America. But in other parts of the world, populism unfortunately is in the rise. And also about technological innovation, some people are utopian. They believe that all the innovation are going to imply the economic pie is going to rise, the price of goods and services are going to collapse, everybody's going to be better off. But there's a question of distribution of these gains. If you're owner of capital or skilled labor, you're doing well in this digital and globalized economy. If you're a low-skilled worker in advanced economies, and even in some emerging markets, you are more challenged. So the inclusiveness of this technological innovation, what's going to be the future of jobs, of wages, of income, is something that we have to worry about. And while people care about global climate change, unfortunately, this global climate change is continuing, is becoming in many ways worse, and is an issue that actually is not going to affect us only 30, 40 years from now, when the sea level is going to rise. Some people worry that some of these extreme weather events we see recently, on one side droughts and fires and famines, on the other side floods and tornadoes and typhoons, or even El Nino, may have to do something with global climate change that leads to massive weather effects that have a huge economic cost. And even your country recently, because of El Nino and floods, that had significant economic damage. So maybe global climate change affects things in the short run, not only in the long run. Number of geopolitical risks around the world, whether it's the situation with Russia, the Middle East that is burning, issues with North Korea, but even risk of things like cyber warfare eventually becoming significantly damaging. So those are the positives and those are the negatives. If you look at about the shorter term, I think the good news about the global economy is that today we are in a period of economic expansion, where expansion is defined by positive growth is accelerating, as opposed to a period of economic slowdown, where growth is positive but decelerating. We had two risk-off episodes in the last couple of years that led to an economic slowdown. One was in August, September of 2015, when worries about China hard landing led to a correction in financial market, risk-off, 10% fall in US and global equities, and a slowdown of global growth. And then the second episode was January and February of last year, where again, worries about China hard landing, stall of US growth, Fed starting to hike, oil and commodity prices collapsing sharply, worries about Grexit, and you name it, led to another episode of risk-off. Both episodes led to a short-term slowdown of the global economy, but then many of these growth scares about the US and China turned out to be just scares rather than real slowdown, and the policy response by the Fed, ECB, BOJ, BOE, PBOC, and other central bank, and also some degree of fiscal stimulus led to a recovery of the global economy. Now, since last summer of last year, we've been in a period of a global economic expansion, where growth is gradually picking up after these two periods of economic slowdown. And that's positive, and we see it also in both advanced economy, US, Europe, Eurozone, Japan, and also emerging markets. Worries about China hard landing have disappeared. Most emerging markets are picking up in terms of their growth. Even those that had a severe recession for a bunch of reasons, like Russia and Brazil, are closer to be bottoming out, and maybe they'll have some positive growth this year. And financial markets have reacted to this better global economic outlook by starting to rally. This reflation trade started even before the election of Donald Trump in the United States, and then became known as the Trump trade or reflation trade. Now, one of the paradoxes about this global economy is the following one. People talk about the global acceleration and call it global reflation. But if this global reflation is driven by an increase in global aggregate demand, in addition to an acceleration of global growth, we should also see an acceleration of inflation, at least in the advanced economies, where inflation has been close to zero. 2 years ago, we worried about deflation. And the paradox today is that while global economic growth is accelerating, including advanced economies, inflation, core and headline in US, in Europe, in Japan, not only still low, but actually is trending down rather than trending upward. So if positive aggregate demand driven by monetary fiscal stimulus and better fundamentals and better confidence is leading to greater growth, why inflation is falling, first question. And second question for central banks in advanced economies, should they normalize monetary policy or not? I think one of the explanations of why maybe inflation is falling rather than going up is that in addition to stronger aggregate demand, today we also have positive supply shocks. What are these positive supply shocks? Maybe all this technological innovation are leading to an increase now gradually of potential growth. Maybe we're better able to measure the impact on output of these innovations and impact negative on prices of goods and services coming from this innovation, reduce the price of many goods and services. Oil fell to 30 last year, recovered, but it's still around 40, 50, half as much as it used to be when oil was trading at 100. And that's a net positive for those that are all importing countries. That's a positive supply shock. Maybe there are things with the labor market. In advanced economies, NAIRO, the natural rate of unemployment, keeps on falling because there is no acceleration of wage growth in spite of a lower unemployment rate. And the Phillips curve is flatter. The reduction in unemployment rate is not associated with an increase in wage inflation or overall inflation. That's maybe another positive supply shock. And of course, the BIS and many others believe that globalization is also a positive supply shock. You have 2.5 billion Chindians, Chinese and Indians, joining the global labor supply, and hundreds of millions more in Latin America and other parts of emerging markets. They produce more goods, more services. Many of these goods and services are becoming more tradable, and therefore these cheap goods and services imply a positive supply shock for the global economy. Now the question for advanced economy central bank is the following one. They were in a process of normalization. Fed ended QE, or started to normalize rates, and even ECB and other central banks have started to signal maybe it's time to start tapering their own QE and eventually normalize rates. But inflation, instead of going higher, is falling. What should be the policy response? It depends on whether the supply shocks are temporary or permanent. Many of the central banks have said that they're temporary, driven by temporary factors, and therefore the process of normalization should continue. And instead, if these shocks were more permanent, then you have to react to them to have a situation where inflation expectations are not de-anchored on the downside. But then there are some people like the BIS who say, even if these supply shocks are permanent rather than temporary, you should not react to them for several reasons. One, maybe the permanent level of inflation is lower than before because of positive supply shocks. You should accept a target of 0 rather than 2%. And secondly, if you try to aggressively try to achieve 2% when that's impossible, instead of goods inflation, you might get asset inflation and bubbles, and you could lead to financial instability. Now, central banks around the world, until recently, had decided that the shocks were temporary, and you have to worry about financial instability, and therefore the policy normalization should continue. But in the last few weeks, whether it's the ECB or the Fed, they're having second thoughts, because we've had now several quarters of inflation keep on falling and falling and falling, and they don't buy the argument that your inflation target should be 0. rather than 2%, and therefore they're reconsidering the pace at which they have to normalize rates. Certainly, one of the risks in the global economy is one of the policy normalization by central bank. It matters for advanced economies, it matters for emerging markets. You can make two mistakes, either to hike and exit this policy too late, eventually causing inflation, or doing too fast and then slowing down economic growth or leading to a stall. And there's a debate on how fast you should be normalizing. And given this paradox of stronger growth and lower inflation, there are serious dilemmas that central banks in advanced economy are addressing, and they have to make tough and difficult decisions one way or another. So that's the background. I would add on the United States just the following observation. After Trump was elected, there was a rally in financial market that is continuing until now, at least in the equity markets, because there was hope that his own economic policy would lead to stronger economic growth. That's why equity were higher, long-term interest rates went up, the dollar went higher. I think that financial markets have overestimated what Trump can achieve and its impact on potential growth, and they are underestimating some of the negative impacts on growth of some of his policies. What on the first side? I think, first of all, because of a whole range of reasons, he's not going to achieve as much in terms of healthcare reform, tax reform, and other things that are impediment to economic growth, like infrastructure. And even if he was able to implement some of the things, potential growth in the United States is maybe at best 2%, and even structural reform in advanced economy like US can lead to growth maybe go from 2 to 2.3%. It talks about growth of 3-4%. No serious economist believes that the potential growth of the US, even with reform, can go to 3%, let alone more than that. So I think markets overestimate both what it can achieve and the impact on potential growth. In the last few months, the movement downwards of the dollar and of long-term interest rates are consistent with markets now realizing that maybe what he promised cannot be achieved. The stock market is still higher, in part because his policies are going to favor capital over labor, and in part because lower interest rates and lower dollar can help the equity markets. But there has been a correction of this Trump reflation trade. And on the negative, I think markets have underestimated some of the risks. The risk of protectionism and of beginning of trade wars. The first thing he did in power was to cancel or not accept anymore TPP. That would have been beneficial for US, Latin America, and Asia. That was a huge mistake. Is now renegotiating NAFTA and other trade agreements, and the risk is that eventually you lead to protectionism and to trade wars. So far, however, some of the more risky things that you could have done, like across-the-board tariffs or branding some countries like currency manipulators or introducing a border adjustment tax that is effectively an import tax, have not been done. But I think that's one risk. The second risk to the US is that restriction to migration, not just from Arab states, but restriction of migration from Mexico, Latin America, even of skilled workers, may reduce the supply of labor in a country where aging of population implies there is less labor supply. And if those restrictions to migration were to occur, potential growth in the US is going to be lower. Third risk is that is micromanaging the private sector, is telling them where to produce, where to hire, where to invest, and so on. Every day tweeting about firms are doing the right thing or the wrong thing. That form of micromanagement of the private sector is distorting economic investment and hiring decisions. The fourth risk that is going to be in the US is that you have a wrong policy mix. If you reduce taxes without paying for it, if you increase defense spending and infrastructure without paying for it, the deficit could become much higher, long-term interest rates could go higher, the dollar could go higher, and therefore you're going to hurt those who voted for you, white, blue collars, who are in manufacturing, through a stronger dollar. And if there was a fiscal stimulus that is excessive in an economy close to full employment, the Fed will have to react by tightening sooner, faster, and more. That will push further the dollar up, long-term interest rates up, and will damage economic growth. So far, because of political incompetence, they are unable to do tax reform, they are unable to increase defense spending, they are unable to do infrastructure spending, and that's why long rates and the dollar have gone south rather than north. But you never know that the policy mix might go again in the other direction. And of course, The other big uncertainty is that not only the chairman of the Fed, but several members of the board are going to be chosen, 5 of them, in the next 12 months, and it's not clear whether they're going to be more dovish, more hawkish, in which direction the new Fed, not run by Janet Yellen, is going to go. That could be a source of uncertainty. I don't have time to talk much about Europe or other advanced economies. The good news about Europe is growth is picking up, financial risks are lower, the risk of deflation is lower, and the risk of a significant rise in populism has been contained given the results in election in Netherlands, in Austria, in France. Germany is going to be also fine. The big question mark in Europe is going to be Italian election next year, where an anti-Euro populist party may or may not come to power. But Europe is not a source of risk for the global economy. That leads me then to say something about emerging market economies and what's happening in emerging markets. If you look at the last 10, 15 years, there have been different cycles in emerging markets. The period between 2003 and 2013 was a period that was a golden years for emerging markets, strong economic growth and asset prices and financial market rising. There were 3 major global tailwinds that were supporting the great economic performance of emerging markets during that decade. There was a rise of China growing around 10% until 2013. There was the commodity supercycle boom, helping most emerging markets are commodity exporters. And after the global financial crisis, of course, with zero policy rates, QE, easy liquidity in advanced economies implied a flight towards emerging markets. The liquidity was going to emerging markets, supporting economic growth and asset prices in those financial markets. So those were 3 major global tailwinds that supported the economic growth of these emerging market economies. Then a shock occurred in 2013, and we had 3 bumpy years between 2013 and 2016. The tailwinds became headwinds. China is not growing anymore 10%, at best 5-6%. Probably the potential of China is closer to 5. The commodity super cycle is over, not just because of the slowdown of China, but also because years of high prices led to technological innovation and increase in production and capacity. So supply entered in the market, new supply when demand from China was slowing down. So there was a supply shock. And however, slowly, of course, the Fed finished its own QE tapering and started normalized rates. So the flood of money in emerging markets coming from cheap money in the advanced economy is now gradually being reversed. And slowly, after the Fed, other central banks in advanced economies like the ECB will start to normalize and move away from unconventional monetary policy. And of course, in 2013, the switch of the Fed position led to a taper tantrum and a shock to emerging markets. In addition to these 3 global headwinds, China, commodities, and exit from zero policy rates, there were other factors that led to some shocks to emerging markets after 2013. In the boom years, when money was easy and flooding emerging markets, monetary policy, credit policy, and fiscal policy in some emerging markets became looser. People talk about the fragile 5 at that time, countries like Brazil, India, Indonesia, Turkey, South Africa, but there were other emerging markets that had also the same fragility. Easy money led to loose monetary, fiscal, and credit policy, and led then to twin current account and fiscal deficit that, as we know, lead to a buildup of private and public debt and economic fragility. Secondly, many of these emerging markets did not continue to do in the boom years the kind of structural reforms that lead to an increase in potential growth. If anything, after the first generation of structural reform, the second generation structural reform, the way the World Bank calls them, were stopped. The micro one that increase productivity growth. That is important. Once you reach middle income status, you have to increase your growth and avoid the middle income trap by doing micro reforms that increase potential growth and productivity growth. With the exception of some emerging markets, Mexico, India, and a few others, many of them did not do those structural reforms. If anything, the ruling economic model in many emerging markets became the one of the success of state capitalism, like in China and other countries like Russia and others, even Brazil, moving in the direction of state capitalism too much role of state-owned enterprises and state-owned banks in economic activity, resource nationalism, even some forms of protection in form of import substitution, industrialization. So the stop of this structural reform with some exception implied that then potential growth stalled and became lower. So it was a combination of global factors, macro factors, and then structural factors that led to that slowdown of growth. Now, the good news, however, about the emerging market is even the shock of 2013-15 did not lead to severe economic and financial crisis in emerging markets, because emerging markets learned the lessons of the EM crisis that started, in the 80s in Latin America, and then you had Mexico in 94, the Asian financial crisis in 97, 98, and then Russia, Turkey, Brazil, Argentina, Ecuador, and a whole bunch of other ones between 1998 and 2002. They learned it, and they changed their economic policies in a substantially more resilient way. Many of them that had more fixed exchange rates moved to flexible or managed exchange rates that become shock absorbers when you have external shocks or in terms of trade shocks. That's a positive. Many of them build up the foreign reserves that they were in short supply during previous crises and allowed themselves self-insurance by having buffer of reserves when there are international or other shocks. There is less liability dollarization in Latin America and emerging markets, and that's a benefit because the balance sheet effects from a falling currency, when you have foreign currency debt, can be large if you have excessive amounts of liability dollarization. With more stable economy, there is more issuance of local currency debt. That's a positive. There are less solvency risks, both in the private and public sector. Debt ratios are lower than they used to be, and therefore not just the risk of liquidity crisis, but of solvency crisis in emerging market, with few exceptions, is lower than before. Of course, in the countries where there were the twin deficits and the macro imbalances, Fragile Five and others, in 2013, there's been significant macroeconomic adjustment. After that, tighter monetary policy, tighter fiscal policy, tighter credit policy. So those imbalances are becoming smaller. In most emerging markets right now, there is better supervision regulation of the financial sector and the banking system, and therefore these banks are sounder, more capital, more liquidity, less leverage, and therefore the risk of banking crisis in emerging market is lower than before. Many of these emerging markets, however, slowly are still embarking in structural reform. The fact that you have moderate center-right, center-left governments in power implies that maybe those reforms are occurring slowly compared to what's desirable and optimal, but they are occurring. And that's certainly a positive. And as I pointed out, in Latin America, populism is not that popular, luckily, and therefore there is economic and policy stability. And from a medium long-term point of view, there is still a process of catching up and economic convergence. Potential growth in emerging markets should be much higher than advanced economies. And with the right macro policies, with the right institution, with the right microeconomic policies, potential growth could be 5% plus in the average emerging market as opposed to 1-2 in advanced economies. And therefore, that process of convergence is going to be helping emerging markets. Of course, there are risks. Some individual emerging markets are still fragile. And of course, the biggest elephant in the room today is China, a country that has an impact not only on Asia, not only on commodity markets, not only on emerging markets, but also on the global economy. Now, for a couple of times the last 2 years, people worried about a Chinese hard landing and the risk that would imply for the global economy, commodity prices, and financial markets. I think that the views on China have been too extreme. On one side, those who were too optimistic would say China will have a smooth, soft landing. And on the other side, those who believe that the economy and the financial system will go crashing and have a hard landing. I've always been in the camp of those who believe that the landing of China is going to be bumpy, neither soft nor hard. The good news about China is growth has stabilized. Second quarter, 6.9. The risk of a hard landing is lower, and therefore that leads to stability for China, emerging markets, commodity markets, financial markets, and the global economy. Those two risk-off episodes that occurred in the last 2 years are unlikely to occur this year. The bad news about China, however, is that today and this year the emphasis is on growth and stability as opposed to rebalancing and structural reforms. There is still too much bad debts, bad assets. There is too much leverage, too much overcapacity. And for the last 2 years, when China slowed down, the worries about hard landing, they doubled down on new rounds of credit-fueled fixed investment. That means more bad assets, more bad debts, more leverage, more overcapacity. So growth in China is stabilized, but not because of significant rebalancing, but because of kicking the can down the road. Now, this year there is the Party Congress, and of course, because of that, as I say, stability and growth trumps rebalancing and reform. And the big question mark is going to be about next year. After Party Congress is over, after President Xi Jinping is going to put even more of his loyalists in the Standing Committee of the Politburo, will he become a true reformer and accelerate the reforms, in which case China is going to remain stable, or because of political pressure, they're going to keep on kicking the can down the road, and then eventually financial and economic risks of China could become serious over the medium term. We don't know the honest answer to this question, whether it's going to be one way or another, but certainly whatever China is going to do next year is going to be important in terms of making sure the zone growth remains stable, and therefore the economic and the global outlook is going to remain stable. Final observation I'll make is the following one. In the last few years, there have been at least 2 episodes of risk-off with a 10% correction in US and global equities, and nervousness in financial market that had some spillover on emerging markets. Usually, those risk-off episodes occur when there is a trigger, and the trigger in the past were worries about China, about Europe, about the Fed, about US growth, about oil prices, and so key emerging markets. So people say, asset prices look frothy today. US equities are probably overvalued. There's nothing cheap in asset prices. Public equities are not cheap, private equities are not cheap, government bonds are not cheap, credit is not cheap. If you look at many asset classes, they're not cheap. EM assets were expensive, then they corrected in 2013-16, now they've recovered. I wouldn't say they're expensive, but not cheap either. And therefore the question mark is, would there be another shock that leads to another risk-off episode, and would that be persistent or not? Usually you need a trigger, even if valuations are high, unless there is a shock, there is not a correction. The good news for the time being is that the traditional shock that will lead to another panic in the markets are not there. This year, China is going to be stable. Europe is economically and politically okay. Trump is a noise at the political level, but US growth is going to remain stable. Inflation in the US is not too low, it's not too high. The Fed is exiting gradually. And even if there are many geopolitical problems in the world, none of them has an impact on the supply of oil or other factors that have a real economic and financial impact. So for the time being, I would say things are okay. Next year, things could be different. China will have to reform or eventually be trouble. The Italian elections might lead to some political shock in Europe. Maybe there'll be a conflict with North Korea or other geopolitical risk. Maybe the noise from the Trump policy is going to lead to more populism, like trade restriction, that could be negative for markets and for economic growth. There are plenty of other risks, like even cyber attacks and so on. And final observation is the following one. For the last few years, every time there was a risk-off episode, the impact was temporary. For a couple of months, you had a correction of US and global equities, and then things recovered. And they recovered in part because the Fed, the BOE, BOJ, ECB, PBOC reacted through either more monetary easing or by postponing normalization, like the case of the Fed. The trouble, however, is that central banks may be running out of bullets, and unconventional monetary policy may be becoming ineffective. So the question mark is the following one. Suppose another major global shock occurs and there is a risk-off episode. First, will the central banks be willing to come to the rescue of the economy of the market? First question. Second, even if they try to come to the rescue of the market, what if these unconventional policy increasingly become less effective because you have used them so much, and then you react, and if you react and the market don't react, then at that point you could have more volatility. So that's an open question. So to conclude, the skies look clear for the time being, and I would say for the first time in long times, maybe the positives are more than the negatives, but there is plenty of things that can still go wrong, and therefore the lesson for emerging market is the following one. There'll be always volatility, there'll be always global shocks, but as long as your institution are sound, as long as you structure reform, as long as you have sound monetary and fiscal policy and credit policies, there may be bumps along the road, there may be shocks that may hit you, but your ability to absorb the shock is going to be quite robust as long as you have the right institution and the right macro, structural, and long-run policies. And therefore, the best insurance against these global shocks is not to close yourself up, is not protectionism, is not populism, is actually to opening up even more and then be able to survive and thrive by having good institution and good economic policy. My positive, optimistic note for emerging market in general, for Latin America in the specific, and even specifically per Peru, is that the direction which policies are going overall is the positive one, which emerging markets have learned the lessons of the past, and institutions and policies are going in direction in which more stability, more term, long-term economic growth, and more welfare is the way ahead. And that's a positive note for the global economy. Thanks very much for your attention. It's a great pleasure again being here with you today. Thank you.
Thank you very much, Dr. Roubini. We thank you all for your kind attendance this morning and for joining us today, and we wish you a great day. Thank you.